Good morning and welcome to this Monday, November 30th, 2020 edition of Trading Places Live here at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. We got some mixed futures this morning. First of all, I hope everybody had a happy and safe Thanksgiving. It certainly was a Thanksgiving unlike most others that we've had, but still, it's always nice to be thankful for some of the things that we have, and hope everybody enjoyed their weekend. Right now, I'd say, with 1 month left in 2020, I don't know about everybody else, but I'm kind of excited to get into 2021. This has been quite the year. I think we've negotiated things pretty well in terms of the stock market, but obviously there's been quite a scare and continues to be in terms of health. And I'd love to see this all put behind us. And I think hopefully based on the positive vaccine news that we've had the past few weeks, that we will get to a point, hopefully in the first half of 2021, where we can at least begin to think about returning to some kind of normalcy. But yeah, as we get close to the end of the year, just I think it's normal to kind of reflect back on everything we've been through, and it has been quite a year for everyone. As we get ready to move into December, I think the market looks pretty solid. I was looking at the charts really globally and within the US market, just looking at the various sectors and industry groups and so forth. And the pandemic index that I follow, that I created, has broken out well above the high back in June now. So we're beginning to see the wider participation among those stocks that will do better once the virus is behind us. So I think Wall Street's beginning to see the light at the end of the tunnel. And I think it's all really good news. Then you got the Fed. I mean, if you talk about the things that make the stock market really tick, it's earnings and it's interest rates. I mean, those are the two things that drive the stock market. And we had a very strong economy back in January, February, before the virus hit. I believe I've, said all along, I believe fully that once we're beyond this virus, I think there's going to be a tremendous amount of pent-up demand. I think we're going to see a huge GDP in 2021. That's just my opinion, and beyond. But I think really in 2021, we're going to get things kicked off, and that's going to lead to some soaring earnings. And then you throw the Fed in, and the Fed is, they're saying, hey, we're going to sit on our hands. We're not doing anything for a while. We don't even care if inflation picks up for a little bit. We want things to really get going. And so they're talking about not doing anything with rates for another few years. I mean, high growth in a historically low interest rate environment is going to lead to some valuations that I think a lot of folks that watch the market can't comprehend right now. And been talking about it all year, and we're seeing it. We saw it with a lot of the stocks that did well during the pandemic, but I think we're going to see it flow, carry over. So anyhow, that's just some of the things that I see as we go forward. Let's go ahead and move on. I'll show you what's going on over here at earningsbeats.com. If you're new to Earnings Beats, we'd love to have you join us. We have a free Earnings Beats Digest newsletter, so you can become part of our community just by signing up for that. No credit card required. You can unsubscribe at any time. Actually, this morning I featured another stock that I'm watching closely in terms of short squeezes. It wasn't, I don't know, maybe a couple of months ago, I wrote about the mother of all short squeezes, what I thought could be the mother of all short squeezes, which is GameStop. I don't know if you looked, but today GameStop's up another 8%. I think it's trading at 17 and change. Back after it reported earnings, it was at $6. I mean, we're talking about in a couple of months, the stock almost tripling. So it's really important to understand the impact. And I like to refer to it as the short-term inefficiencies of the market that you just don't know necessarily by watching CNBC or just following what the S&P 500 is doing. There are things that happen at the individual stock level that from a short-term trading perspective can lead to a lot of gains. It also can lead to a lot of volatility, so you got to be willing to stomach that. But there are opportunities in the market all the time. And, GameStop's just one example. I mean, we've seen so many of these short squeeze stocks that just take off. And with the pandemic index breaking out, I think that's leading to a lot more of these unloved stocks moving higher. Now, I'd stay away from the ones that aren't moving higher, but the ones that are breaking out and you're seeing the volume pick up, I think there's some tremendous short-term opportunities if you're a trader. I mean, take one look at Nordstrom's chart, and you can just see the stock's been going up day after day after day after day. Shorts are in a box. You know, you got, I don't know what the percentage is on Nordstrom's, made 30 or 40% of their float is short. When you get breakouts, these are guaranteed buyers, just depending on how much pain they can take as the stock keeps going higher and higher and higher. But anyway, could talk about short squeeze all day. But here you can see where you can sign up for that free newsletter. I'd love to have you there. If you want to try our service, there's a join today button. You can see it's a $7 fully refundable, $7 30-day trial. So if you sign up, costs $7, we'll give it back to you. So we're literally a no-cost 30-day trial. You can see our portfolio performance here. Not going to go through all these numbers, but I do want to point out model portfolio now up 185%. That's almost a triple in just over 2 years. That, in my wildest dreams, I never thought that we would see anything approaching this kind of outperformance. I figured we'd probably outperform, but I never thought that we would see this kind of outperformance. And so anyway, I just think it's pretty impressive. And if you want to join, you can check out all the stocks that we have in our portfolios. All of our members can download these. We have 10 equal weighted stocks in each one of these portfolios, and each of them are in their own separate chart list that you can download right into your account if you're a Stock Charts member. Speaking of Stock Charts membership, I don't want to take too much time, but I want to make sure everyone's aware, especially those of you that are Earnings Beats members, and maybe you're not a Stock Charts member right now, or maybe you are. And if you are, you should be looking at this special. If you go into their site, it's going to be hard to avoid because they've got the banner ad up there. But I've been at Stock Charts, and used the service now for probably 16, 17 years. I don't know how long. But this is the best deal I've ever seen. And I don't get anything for saying that, by the way. I'm just telling you, if you're a Stock Chart subscriber and you've got the ability to extend right now, I would do so. 4 free months when you sign up for 12. I believe it's 16 for 12. So that's the best deal I've ever seen Stock Charts offer. And I would suggest that you think about taking them up on that. It's only one day. It's today. So don't forget about it. Tomorrow it's gone. All right, let's move on to what happened on Friday. It was an abbreviated session. Market closed at 1 o'clock. I ended up not getting out a daily market report. I mean, I watched the market, but there really just wasn't a whole lot going on. And so I just decided to kind of take the day off. But you can see the Dow Jones Industrial Average finished up 37 points, the S&P up 8. NASDAQ had a pretty good day, up 111 points, almost 1%. And you can see the breakout above these recent tops and up there challenging that September high. Mid caps, they were up fractionally, small caps basically flat, but both these areas of the market have been performing extremely well. Looking at the sectors, healthcare bounced back. Biotechs had a pretty nice day on Friday, leading healthcare higher, so that was good. We're right at that 20-day moving average, and after breaking out above the September-October double top right there, we've actually pulled back and testing that area and the 20-day moving average. And I'm going to talk about seasonality in a little bit, but healthcare likes the next few months. So we're on the 20-day moving average. Healthcare, you find some of your favorite healthcare plays out there. It might not be a bad trade here over the next couple of months. Communication services also likes the period, likes December, and then also likes the next few months. And so seeing this group breaking out above that September high, just as we head into a seasonally favorable period, I think is also something to be aware of. Energy, after the huge run, actually struggled on Friday, came back down 1%. It's had a couple of days last week where it's pulled back, but my gosh, the gains that group saw. And I'll be honest, I didn't really participate in it at all. I don't think I had any stocks that I can think of in energy over the past month because I just don't trust the group. I'm not surprised that we're seeing a rebound. Secular bull markets tend to carry everything higher, and energy had been lagging for several months. So it definitely has been playing some catch up. I'm just not convinced. I'm not seeing a lot of energy stocks beating earnings estimates. So this is something that we might see as we go forward. But for now, I think, it's nice to see. I want all these areas to participate in this bull market, but I'm just not seeing enough in terms of the fundamentals for me to be overly interested in this group. Renewable energy, best performing industry group on Friday. I mean, the hits just keep on coming in terms of movement to the upside in renewable energy. This has been a very, very strong group in 2020 and throughout the pandemic. And we see it continuing. Another big day on Friday, up 3%. So renewable energy continues to be strong, although it is overbought in the short term. Gas distribution, this is in the utility area. This was the worst performer on Friday, down almost 2%. Got right up to some overhead resistance from August. I think we probably saw a little bit of profit taking there. I suspect we're going to get a breakout, just like we're getting breakouts across most areas of the market. I think it's coming for utilities. I think eventually it's coming for a lot of the areas in energy, but it's not so much, are these groups going to go higher? But the real question is, are they going to lead? Are they going to be relative leaders? And that's where I have a little bit more of an issue going forward. I just don't think that's going to be the case. All right, let's move on. 10-year Treasury yield. We did have a couple of earnings reports. Actually, they're coming out. Haven't seen them yet. At 9:45 Eastern, so in about a half hour, a little over that, we'll have the November Chicago PMI coming out. The expectation is 59.2. October was 61.1, so we are looking for a little bit of a drop there. So far, 10-year Treasury yield, I was up this morning. Let me get an update for you. Yeah, it's come back down off that high. It's still up about 1 basis point, 0.85%. This would be an area that I really would be looking for movement back to the upside in the 10-year Treasury yield. I mean, we're sitting almost on what I would call a short-term trend line here, if you connect these recent lows. So we've been trending higher, got up and essentially put in about a double top based on that high in June, pulled back, not unexpected. I'd watch maybe gap support, which is down around 0.82%. The 50-day moving average, which is getting close to 0.8%. Those would be the areas that I would watch the downside, but I do expect movement back to the upside. And if you're new to the show, one of the things I look for is when the Treasury yield's moving higher, that it means money is rotating out of Treasuries, and that's usually a good thing for the stock market. So if we do get that bounce, I think that will help us in equities in the month of December. We'll see. All right, let's talk a little bit about a couple areas. I think gold was down another $16 or $17 this morning from what I saw. And we had, more vaccine news out today. Moderna, it seems like each one of these companies making these vaccines trying to top each other from one week to the next. But Moderna said, we've got some new data. We're over 94% efficacy. And so that, the stock was up big last week, and it was up again big this morning. So that's something to watch today. Moderna, that helped to lift VERTEX last week, and especially on Friday. And it looks like it'll probably give VERTEX another lift this morning. But looking at gold, I've said before, I'm not a fan. Short term, when we get an uptrend, you can certainly trade gold, and I'm okay with that. I wouldn't own it for the long term. I just don't. I think when the fear comes out of the market, which is what we're seeing now and what we've been seeing, this is typical behavior of gold. Gold, to some extent, relies on fear. It also relies on a dropping dollar, a falling dollar. So those are the two things to watch for. And there have been periods over the last couple of years where we've seen the dollar, moving down, and gold really hasn't benefited from it. And so I'm not even sure the dollar is going to lift it, especially with fear dropping. So as the stock market has taken off in November, we've had this huge rally in November. I think when I looked, the S&P was up like 11% this month. Gold, you can see, is getting absolutely crushed. And so for me with gold, it's not so much about the absolute chart. It's about the relative chart. And gold relative to the S&P 500 throughout this bull market and throughout most bull markets, it struggles. Now, if you look back to the bull market we had from 2002 to 2007, that was a cyclical bull market within a secular bear market. It was a little different bull market, and it also had a very strong or very weak dollar back from 2002 to 2007. So gold benefited from the fear of being in a secular bear market, and also benefited from the falling dollar. So a lot was going on back then. But since 2011, gold has just been an underperformer, and I'm looking at the absolute chart, and I see no reason to be overly excited about gold here. Probably bounce at some point, but we're now in what I would call confirmed downtrend in the short term. My guess is we'll probably consolidate, but even if we go higher, I still think the S&P 500 goes higher faster, if you will. All right, let's move on. I'm going to pull up the S&P 500, and we're going to take a look at the 60-minute charts. Let me get that hourly chart up here. And I'll even lengthen this a little bit, go back 3 months. So you can see the huge month that we had, or the huge start to the month we had back at the beginning of November. And then we pulled back. We held on to the gap support. Notice we've been holding on to that. We're now at the top of this range that was set back on November 9th. So I think we're at a pretty key area here. I wouldn't be surprised maybe if we pull back because we are at a key resistance area, and we do have futures down a little bit this morning. But I don't think we're going to be down for long. I really don't. You know, the one other thing to think about from a maybe from a short-term perspective is, let me go back here and pull up the equity only put call ratio. And you can see the numbers down here pretty low. You know, I know December tends to be a pretty bullish month, and I know that the equity only put call ratio tends to be, you know, pretty low in the month of December, but we're talking about some pretty serious lows here that we've been, you know, getting down to the 0.3738 up to 0.4 range, which means, I mean, we're talking about equity puts divided by calls. So you've got number of puts being traded, equity puts being traded, divided by the number of equity calls. And so as the number gets lower and lower, it means that with the numerators getting smaller relative to the denominator, which is equity puts are getting smaller relative to the calls. So you're getting a lot more folks that are interested in buying calls. And that can be somewhat dangerous for the market in the short term. This isn't something that I look at and say, oh my gosh, we're heading into a secular bear market. This is a short-term market thing. It kind of gets back to the short-term inefficiencies that I talk about in the market. When everybody wants to get in on the call side, you got to be careful, especially as we get closer and closer to options expiration Friday, the third Friday of every month. So we still got some time. We're talking about this coming, it'll be what, the 4th, 11th, 18th. So options expiration will be on the 18th of December. So we'll have our Max Payne webinar on the 15th to talk about some of the things that we might be looking for and looking at in terms of how the market could perform heading into options expiration Friday, or maybe even a couple days into the following week. But that's still down the road. Short term, I don't know that this is going to play in right now, but it definitely could, like I said, in a couple weeks. If this stays really low, if the market stays bullish and we keep seeing a lot of calls being bought, that could become problematic as we work our way into December. And that'll be something we talk about, you know, as we get there. All right. Let's see. I'm going to go ahead and move on. I want to talk a little bit about seasonality. So if you look first at real estate, now I just sent out a seasonality report to our members, went out on Saturday, looking ahead to December and some of the things that we can be anticipating based on history. No guarantees, but if you have an idea of what typically performs well in December, you can take a look at the chart and see what the chart looks like. You know, if you're pulling back to a major support level and you have the knowledge that a stock or an index or a sector tends to perform well during that month, and technically you're getting a buy signal, that can be a powerful combination to know that history has your back on the long side. So those are the things I try to focus on. I don't really look at the negatives. I mean, we're in a secular bull market. I've been saying it all year. I'll keep saying it. I'm not looking at what doesn't work. I'm not looking at the negatives. I'm not looking at something to be shorted. If I'm in a secular bull market, I feel like I want to ride the wave in. I don't want to try to swim out away from shore against those waves. I want to get on my board and surf. I want to ride in with that wave. And so that's the way I approach the market. When I believe we're in a secular bull market, I'm looking for opportunities on the long side, not the short side. And there are some who just only want to short. They want to look at the market and say, it's too pricey. I can't believe Tesla keeps going up. I'm going to short it. I'm going to short it. Well, that doesn't work out very well when Tesla is leading the market to the upside. I don't like that approach to the market. I like to go, Wall Street's telling us something with Tesla, has been telling us something. And so you don't want to ignore those messages. That's why Tesla's in our model portfolio. That's why our model portfolio is outperforming, because we're listening to what Wall Street's telling us. Well, when I look at the XLRE, which is a real estate, I'm not a big fan of real estate because it's a defensive area. And I tend to avoid defensive areas when I feel like we're in a secular bull market advance. Why? Because defensive areas tend to underperform the S&P 500. They go higher. Everything tends to go higher, but they don't go up as much as the S&P. So you normally look for leadership in technology, consumer discretionary, communication services, industrials, financials, those areas, not necessarily real estate. But I will say this, real estate over the next 3 months, if we look back over the last 20 years, real estate's been the best performing sector for the next 3 months. The best performer in December and also the best performer over the 3-month period. Although I think February, it comes down a little bit. It's a little bit of an underperformer. I think the real strength is December and January. And rather than think, let me just show you. So if you go in here, if you're not familiar with seasonality, this is a great tool. So you just click on the seasonality in the dropdown, and then we put in XLRE, and you'll get a 5-year. The default will be a 5-year look. So you can look at it and say, okay, over the last 5 years, November's gone up 60% of those years, averaging 2.3%. You go back over the May, June, July period, all 3 of these months have gone up every year for the last 5 years. And there's your average returns. So, but this is just 5 years, or excuse me, 5 months. No, I had it right the first time, 5 years. So you've only got 5 months. Like in May, you're only looking back through 5 Mays. That's not a huge sample size. I like to drag this bar all the way back. So you can take this and you can go all the way back 20 years. That's the max. I wish it would go back further, but we at least have 20 years that we can go back. And you can see December, 68% of the time over the last 20 years, December has been higher. 3.3% is the average return in the month of December, going back the last 20 years. So, if you just put your money, and I'm not suggesting anyone do this, but if you had a portfolio and you just put it into the XLRE at the beginning of December and took it out at the end of December, based on this, you would have made an average of 3.3% per year. That's pretty good in 1 month. I mean, if you could do that every month, you're talking about close to 40% annualized return. So anyway, the other thing I want to mention here, if I look at these things and I pick up on percentages and stuff. So I look at this and I'm like, okay, 100%, 5 out of 5, 40%, 2 out of 5, 60% is 3 out of 5. How they get 50% of 5? It went up 2.5 months. And then I realized when you look back these last 5 years, December hasn't happened yet for 2020. So you're looking at these 5 years. Well, we've only had 4 Decembers so far. Now, as soon as we have our price action tomorrow, you'll see this go up either to 60% or to 40%, depending on whether XLRE goes up tomorrow. But once we get some data from December 2020, then you'll see this go back to normal. So that's why if you're ever looking at this, and I don't know, guess maybe it's just my background being CPA and just numbers, but I just saw 50%, or not on this one, but some of the charts, I just look at percentages that don't make sense sometimes. And that's, you just have to understand how these numbers are calculated. So for December, we're only looking at the last 4 years. So 2 have been up, 2 have been down, and the average has been down a little bit. So in the short term, we haven't really seen a lot of strength in the XLRE, but there, if we go back 6 years, which now is 5 years for December, you can see that's 3 out of 5 and 0% average return. You just drag it and you can see that, it was pretty consistently going higher And it's only been the last few years, 4, 5, 6 years, where it's been flat. But the longer term history is that the XLRE goes higher. And when I start seeing 68% of the time, that's, I get up over 60, 65, 70, and especially 80 or 90%, like looking at July, 84% of July's, it's gone up with an average return to 3%. That I think is worth noting. You got the odds stacked in your favor if you're long real estate stocks in the month of July. I think you've got pretty decent odds in the month of December as well. Now I mentioned healthcare. I want to show you healthcare, and we'll drag this back. So over the last 20 years, you can see November typically is a pretty good month. December, there's your 68%, 1.1%. January is another 1.1%. So these two months combined, 2.2%, which is better than most of the other areas. And then what you can also do is compare it to the S&P 500. This is what I generally do. So here you can see in December, the XLV averages outperforming the S&P 500 by 0.6%. And it's outperformed the S&P 500 a little over 50% of the time. January, we jumped to 65% of the time outperforming, with average outperformance of 1.1%. So this is just to give you some, information as we move into these next few months. The other one I mentioned was communication services. So we'll take a look at communication services. This is relative to the S&P 500, last 14 years. So communication services was broken out back in 2006, 2007. So here's your 14-year look. 77% of the time, though, we've been out. The XLC has outperformed the S&P in the month of December by an average of 1.2%, and that overall outperformance carries into both January and February, really for the next several months. You can see over the last 14 years, we tend to perform pretty well in this area of the market relative to the S&P. The only month that shows negative relative strength is November, which is what we're closing out today. So anyway, this is a group I think also that we could be taking a look at. And some of this was laid out in the seasonality report that I did over the weekend. But there's also 20 individual stocks that I gave to our members that really like the month of December. And they're also laid out, annotated in a chart list. And we should have that on our chart on our website today. If it's not already there, it'll be there today, where you can download that into your own stock charts account and then take a look at the stocks. I mean, these are stocks that have a history. You can check them out for yourself just by coming in and putting in the numbers. I'll tell you one, which is, I think I wrote about it in the Don't Ignore This chart, which was Lululemon. And take a look at this over the last 14 years, almost 70% of the time, it's moved up in December, and it's averaged gaining 6.8% in the month of December. So Lululemon is one that, hey, I would take that information and immediately pull up a chart. And I see the AD line's pretty strong. I see we just broke out above this double top. We've cleared this gap resistance. We got a strong group. It's in clothing and accessories. And while, you might look at this and say, well, yeah, but it's not been a great relative performer. Don't forget that at the high, when Lululemon hit its high in September, it was also hitting a relative high. So this relative weakness came as a result of consolidation. Well, if that consolidation is starting to change, I would expect Lululemon to begin to lead again. So again, you've got a strong group, a group that is now at a 10, 11-month relative high to the S&P 500, and you've got a stock that's been consolidating, showing that it may be ready to make a move, and it was one of those leaders in this group all the way through that September high. So this is a stock definitely worth consideration, simply based on technicals and seasonality. All right, earnings. We got Zoom coming up after the bell today. This is going to be a big report. And not just the report, but then, as we go forward, what do they have to say? Now we're getting vaccine news. Do they anticipate the same rate of growth? Do they think it's going to slow? Do they not know? I think their conference call is going to be really important. I don't think there's any doubt they're going to post some good numbers. I'd be shocked if Zoom doesn't beat 75-cent estimate which is what they're looking for. But will the market react positively to that report? I think some of that's going to depend on what they have to say going forward. But that's a big report. That'll be due out after the bell today. Something to watch for. A couple of companies that reported, and the market is just now opening, so we'll get some action here. Well, this doesn't show just yet. But Auto Home, ATHM, they beat $1.11 versus $1.08. Stock was down 5% in pre-market. See if we get that. Yeah, there we go. It's down 8% now. Looking at it, I don't, relative to the specialized consumer services group, it's been, for the most part, downtrending for months. Not really a big fan there. I think there are others in this space that are much better. Maybe it's being overblown a bit. I think you've got some support down here just below 95. We'll see whether or not that holds. But I'm not overly impressed by the chart. ADNT was up in pre-market. It is up a little bit, 11 cents. This stock also beat its earnings, 115 versus 96 cents. And we come down here in the auto parts area, and this has been a leader. This has been a leader, and the group is starting to lead. So this is not a bad stock at all. AD line's starting to strengthen, trying to move to about a 5-6 month high. Don't really see a whole lot of negative here. I'd probably rather see a 20-day test to kind of minimize my risk, but this is one I'd certainly have on my radar. I think it looks pretty good. All right, let's move on to the 3 you must see. Actually, before I go into 3 you must see, I'll just tell you, we got some pretty good earnings reports coming up this week. I know this, you'd think, okay, we're into the 3rd month of this calendar quarter, so there's not going to be much in earnings. Well, we've got Salesforce.com, and of course, let me pull up Slack work, because they're in the, they're potentially going to be bought out. That's the rumor that's going around, that CRM is looking to buy Slack, and you can see that huge move that was made last Wednesday, and then again on Friday, closing at the high, now gapping up again today. But Slack looks to be potentially an acquiree. We'll see whether or not that pans out. The tough part about getting into a stock like this is, what if Salesforce.com, for whatever reason, says, you know what, we've decided against it? I mean, then you've got a stock at 43 that goes back down to 30. So that's a major risk. I mean, you might get, they may come out and say they'll pay $55 a share. So you might have a huge gain, but you've got to really be willing to take the risk if this deal doesn't go through. Anyway, Salesforce.com reports. Viva, VEV, reports network appliance. I'm going to pull this chart up. Network appliance. They're starting to show strength, breaking out above this triple top. They're now trending higher. AD line looks pretty good. This is probably the best network appliances looked in a long time. It's starting to strengthen relative to the computer hardware group, its peers. It's been strengthening relative to the S&P. So yeah, I mean, this is a stock, again, on the 20-day test would be maybe worth some consideration. Also reporting later this week will be Snowflake, which was a recent IPO. You can see the stock making new highs. They're going to be reporting on Wednesday. CrowdStrike, Splunk, OKTA, Zscaler. They're all going to be reporting on Thursday. We got Dollar General, DocuSign, another big one there, Marvell, Kroger, Ulta. So anyway, still a number of reports coming out this week that could help drive the market. All right, 3 you must see, and then we'll wrap up for today. I'm just going to pull up some charts that have been leaders in the past. Some of these look a little bit better now than they, than the others, and they look better than they did maybe a week ago. But let me pull up these charts and show you what I'm talking about. First, we'll pull up Etsy. What a big move last week. Breaking out, stock up again today, 1.6%, but we're now in breakout mode here on Etsy. Watch the rising 20-day moving average. Any tests of that on a pullback, I think, would be very, very bullish. We consolidated on Etsy for the most part for the last 3 months, and as a result, we saw a little bit of deterioration in their relative strength. Think back to what I was just showing you a minute ago. What was the one I was just Lululemon. So as you consolidate, the group kept going higher, but Etsy was consolidating, and so it was starting to lose relative strength. It actually was at about a 4-month relative low. So if you're just looking at relative strength, you're saying, wow, I don't want to touch this. Well, you got to be careful because during periods of consolidation, that's what happens. The market keeps going up and your stock consolidates, it's going to lose relative strength. So keep that, bear that in mind. Watch major support levels. Uptrends their definition is new, higher highs, higher lows. And so as you make this new high here, as long as you don't go back down below this prior low, you're still in an uptrend. Now we've made another high. So now this low becomes important. But Etsy continues to trend higher. Another stock that I think is worth watching, it's in the biotech space, and it's trying to break out above into this gap, this gap resistant zone. VERTEX, a move through the 50-day and above this high over here on, what is that, October 14th, something like that. A breakout there would be bullish. And biotech, remember, talking about the healthcare area of the market, it likes the next couple of months. And so this is a stock, maybe it will start to get a little bit more love. And then the last one I want to mention is one that was a leader in software for a while. It was in our model portfolio. I don't know if it was last quarter. I think it was the quarter before. But Cadence Design, CDNS, had broken out, has been consolidating. And while it's been consolidating, you can see its relative strength is weakened, but it's starting to look like it wants to trend higher again. Watch the rising 20-day moving average. If it holds and bounces, that is a bullish sign. I think CDNS is likely to be heading back up to test that 126, 127 level. All right, that is it for today. Again, I just want to remind you one more time, if you came in late, today's the only day at Stock Charts. I get nothing from this, by the way. I'm just promoting it because I think Stock Charts is a massive tool for us at Earnings Beats. If you're a member at Earnings Beats and you don't have a membership at Stock Charts, I think you're honestly doing yourself a disservice. I think our service combined with Stock Charts is really what makes us tick. And so if you're not a member, or even if you are a member at Stock Charts, today's their best day. If you want to save money, re-up. 16 months for the price of 12. As long as I've been associated with Stock Charts and, been writing at Stock Charts and so forth, I don't remember seeing a better deal. So this is their Cyber Monday deal. Take advantage of it. All right, that's it. Everybody have a great Monday. Be back tomorrow over at Stock Charts for your next Trading Places Live. Have a great day. Happy trading, everybody.